Hello everyone, welcome to another new video. In this video, we know about the small cap stocks and are they good to invest. So, a small cap stock is a stock from a public company whose total stock valuation or total market valuation or its market capitalization is about $250 million or $2 billion. The precise figures vary. Small cap stock investors are generally looking for up and coming young companies that are growing fast. That is, they are looking for the large cap stocks of the future. What are the key takeaways from small cap stocks? A small cap stock is generally that of a company with a market capitalization of between $250 million to $2 billion. Small cap stock investors seek to beat institutional investors by focusing on growth opportunities. Small cap stocks historically have outperformed large cap stocks but are also more volatile and riskier. Now we see and we will understand what is small cap stocks, and in this small cap stocks what is the meaning of cap. So basically the cap means capitalization, or it's called market capitalization. So this is the market's current estimate of the total dollar value of a company's outstanding shares. To calculate a company's market capitalization, multiply its current share price by the number of outstanding shares. Now, if we classify that large cap, small cap, then these are approximately that changes over time. Furthermore, the precise definition of a small cap stocks versus large cap stocks may vary among brokers. One misconception about small cap stocks is that they are startups or brand new companies. In reality, many small cap stocks are of companies that are well established businesses with strong track records and great financials, and because they are smaller, small cap stock share prices have a greater chance of growth. Now we see what is the difference between small cap and large cap. Small cap stock companies offer investors more room for growth but also bring greater risk and volatility than large cap stocks companies. A large cap offering has a market capitalization of $10 billion or higher. For large cap stock companies such as General Electric and Coca-Cola, the aggressive growth may be in the real view mirror. Such companies offer investors stability and dividends, but rarely fast growth. For example, large cap stock companies dominated during the tech bubble of the 1990s as investors gravitated towards stocks such as Microsoft, Cisco, and AOL Time Warner. After the bubble burst in March 2000, small cap stock companies became the better performers as many of the large caps homogeneous value in the crash. One advantage of investing in small cap stocks is the opportunity to beat the institutional investors. Many mutual funds have internal rules that restrict them from buying small cap stock companies. In addition, the Investment Company Act of 1940 prohibits mutual funds from owning more than 10% of a company's voting stock. This makes it difficult for mutual funds to build a meaningful position in small cap stocks. Now we check the difference between a small cap and mid cap. Investors who want the best of both worlds might consider mid cap stocks, which have market capitalization between $2 billion to $10 billion capitalization historically. These companies can offer more stability than small cap stock companies yet confer more growth potential than large cap stock companies. For self-directed investors, spending the time to sift through small caps to find a diamond in the rough can prove to be time well spent. Even in our data-rich world, great small capitalization investments fly under investors' radars because they get little coverage from analysts. Now check the small cap versus penny stock. Shares in both small cap stocks and penny stocks have lower market value than large or mid cap stocks. Penny stocks were small market capitalization, so they could be considered small cap stocks. However, there are specific characteristics that make a stock a penny stock which not a small cap stocks. So penny stock have prices lower than $5. Some are traded on the New York Stock Exchange or NSE, BSE, many more. Most through are traded directly rather than through a stock exchange. Penny stock are considered high risk investment due to their low price, lack of liquidity, wide bid ask spread. Now, what is the advantages and disadvantages of cap stocks? So, first of all, we'll see what are the advantages of small cap. It have potential growth because these companies are smaller. They are more potential for growth relative to large cap companies. This means investor in them have the potential to make a large profit. Lower share price. The share price of small cap stocks is often lower, making your initial investment easier, and share prices can't be artificially pushed up by mutual funds or hedge funds since there are regulations to prevent financial institutions from investing heavily in them. Again, another is variety of businesses. Small cap companies aren't only startups, they are be found in all industries and many of them have been in businesses for a while. This provides a variety of options for investing. Now we check what are the disadvantages of small caps. Volatility prices. Smaller companies react more to volatility in the market because they have less financial caution than their larger counterparts. As a result, small cap stocks can see sudden and wide price fluctuations. Then another is high risk. While small cap companies have a lot of growth potential, they have equal potential to fail. Small cap stocks are a riskier investment than large cap stocks. The companies usually have less access to investment capital and are more sensitive to market changes. This makes them a riskier investment. Less available information of a company. Financial institutions and analysts don't give small cap companies as much coverage as large and mid cap ones. As a result, you need a solid understanding of company valuation and time to do your own research before investing. Now, what are the pros and cons of a small cap stock? Now, first of all, we see what are the pros. It has potential growth, lower share price, variety of businesses, less population. Now, what are the cons? Volatility prices, high risk, less available information, low liquidity.